Millions of retirees are following advice from 1994, advice that, by our analysis, may be causing them to live on less than half of the amount they could safely spend. I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. In this video, we'll show you why the 4% rule needs a serious update. The 4% rule originated in a 1994 study by a financial planner named Bill Bengen. The study suggested that a new retiree would have low odds of running out of money in 30 years if the retiree spent 4% of their initial retirement portfolio in the first year and every year thereafter increased spending by the amount of U.S. inflation. He assumed an investment strategy of 50-50 U.S. stocks and bonds and that there would be no taxation on investment income until it was withdrawn. To illustrate the 4% rule, if you retire with $1 million, you spend 4% of that in the first year, and every year thereafter, you raise your spending with inflation. If you retired in 1995 with your $1 million, your annual spending would have started out at $40,000 and then increase gradually over time to reach more than $80,000 by 2025. Your standard of living would have been about the same every year because your spending increases would have simply kept up with inflation. Bill Bengen chose 4% as the starting spend level after studying the historical returns of U.S. stocks and bonds. But in 1994, the year the rule was published, an 8% rule would have been feasible. Anyone who followed the 4% rule since then would have spent only half as much in retirement as they could have spent, leading to a very large remaining portfolio at age 95. This chart shows, by year since 1881, the spending percent at the beginning of retirement, which would have been feasible if a retiree had known in advance the returns of U.S. stocks and bonds over the next 30 years. Half the time, a retiree could have started out spending 6% or more of their savings and increased that with inflation and still not run out of money in 30 years. The 4% rule assumed an investment strategy of 50% in U.S. stocks and 50% in U.S. bonds. That's too little in stocks. When stocks will outperform bonds by 4% per year, which is about the historical average, the optimal allocation to stocks is 80% and not 50%, even for retirees. As this chart shows, an 80-20 stock-bond mix would have permitted a higher starting spend and thus a better standard of living in retirement than a 50-50 mix for every starting year since 1881, other than if you'd had the misfortune to retire just before the 1929 stock market crash. On average, the portion of savings which could have been spent was 1% higher with an 80-20 allocation versus a 50-50 allocation. The original 4% rule was indifferent to starting conditions in investment markets. But starting conditions matter significantly. When determining a safe spend amount, it's important to consider that at this point in early 2026, the expected future return of a U.S. stock and bond portfolio is alarming. Here, the green line is the starting spend percentage, which would have been feasible historically. The blue line shows historical estimates for the future return of an 80-20 mix of U.S. stocks and bonds. For U.S. stocks, the future return estimate is based on starting 10-year price-to-earnings ratio, while for U.S. bonds, the return estimate is based on U.S. Treasury yields. You can see that there's a high correlation. When the starting return estimate was higher, the feasible spending percentage turned out to be higher as well. On the right of this chart, we can observe that the expected return as of the end of 2025 was a fair amount lower, about 2% lower than in the mid-1960s when the 4% rule would have failed. This suggests being cautious when deciding what proportion of retirement assets to spend now. Because the 4% rule does not react to changes in the value of your retirement portfolio, it presents a risk of running out of money during your lifetime. If instead you always spend a proportion of the money you have on hand at that time, you will never run out of money. This chart shows the proportion of your current assets that you can spend as a function of how many more years your money needs to last. 4% is still a good starting spend rate if you have 30 years to go, as Bill Bengen assumed. But if you have $1 million on hand and intend to live off your savings for 40 years, you should only spend 3.3% of that, or $33,000 in a year. On the other hand, if you have $1 million but just need it to last 20 years, you can safely spend 5.8% of that, or $58,000. Let's look at the impact of some of these suggestions applied to an individual who retired at age 65 in 1995. I showed you the green line on the chart earlier. It's annual retirement spending using the 4% rule for someone who retires with $1 million. The new orange line shows the impact of two changes. The investment allocation has changed from 50-50 stock bonds to 80-20 stock bonds. And the spending rule applied is the one illustrated on the prior slide. You spend a portion of your current assets based upon the number of years remaining until 2025. The upside of these changes is that there's a significantly higher standard of living in retirement than with the 4% rule. The retiree could spend about twice as much. A downside of spending a proportion of current assets is spending will have to drop when investments have losses. And here we can see dips in spending after the tech bust and the global financial crisis. In order to avoid meaningful dips in spending when asset values fall, it is worthwhile to apply the spending rule to the average assets over the past 5 years rather than to the current assets on hand. That's what sophisticated institutional investors do. I've added a new line to the chart I just showed you, the blue line here. As you can see, if spending were based upon 5-year average assets, there would not have been any material drops in spending in the past 30 years, despite the two major bear markets in equities. As a final suggestion, avoiding bear markets can be dramatically helpful, especially if there's a bear market early in retirement. I've added one more line to the chart, the top line here, which shows the annual retirement spending that would have been possible with an investment strategy of investing 50% in equities when downside risk is elevated and 100% in equities otherwise. No perfect rule exists, but the dashboard which Atlas Capital has developed for assessing downside risk is worth considering. In the past 30 years, it would have made the difference between a modest retirement and a very comfortable one. In sum, the 4% rule was an important contribution to financial planning, but it needs an update. As this video indicates, it's much better to establish a new safe spending amount each year based on your assets, your time horizon, and estimated investment returns at that time. In addition, most of the time, you can safely allocate more to equities than traditional financial advice indicates. Moreover, there is significant potential to improve retirement security if you can reduce losses in bear markets. Thanks for listening. Visit our website to see our current downside risk assessment and reach out if you'd like us to go through the math to develop a personalized spend for your situation. Thanks.